Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. So Wall Street is gearing up for earnings from some megacap companies. Tomorrow after the bell, we'll have results from Alphabet and Tesla. And in a moment, we'll get the tech story from the Asian perspective. I'll be joined by Stephanie Leung. She is the Chief Investment Officer at StashAway. But we begin this morning with breaking news on trade. President Trump saying the U.S. has completed a deal with Japan. In a post on Truth Social, Trump said the tariff rate would be set at 15%. Here is Trump.
We worked on it long and hard, and it's a great deal for everybody. I always say it has to be great for everybody. It's a great deal. A lot different from the deals in the past, I can tell you that.
Trump also said Japan will be opening its markets to U.S. products, including cars and trucks, rice, and certain other U.S. agricultural products. And at the same time, Japan will be investing $550 billion into the United States. Earlier, Trump announced a new trade deal with the Philippines, a tariff rate in that case of 19%. And earlier, Trump touted a major deal with Indonesia, estimating $50 billion in added U.S. market access. Joining me now is David Aspell, partner and co-CIO at Mount Lucas Management. David joining from just north of Philadelphia. Thank you so much for making time to chat with me, David. To what extent now do you believe the market will be confident that we're closing in on the end of this trade war?
Yeah, I think it is starting to express confidence. You're starting to see some trade deals come through. I think you're starting to see some more clarity around what the world post Liberation Day is going to look like. It looked as if Liberation Day was, maybe some of the tariff rates and the way it calculated it seemed very high and a little difficult to accomplish their goals. And that seems like they walked that back. And now that we're on a more sounder footing, I think, and it's easier to see what we're going to look like. A blended tariff rate for the country, 10 to 20%, lower for allies, higher for folk that we're not so friendly with. And we're still trying to change people's approach to trade to make it more balanced and fair and open things up to U.S. goods and services. I think Secretary Bessent has been real clear that that's what they want to do. They did that when they were talking with China, about China as well, that what they want is China to spend more and to become more open to the U.S. And if they can do that, I think it's a game-changing win for the administration.
We had some new data today showing that American businesses and consumers are paying for these tariffs. If you look at import prices, excluding fuel, those prices were up notably in June. And George Saravelos from Deutsche Bank was saying today, the top-down macro evidence seems clear. Americans are mostly paying for these tariffs. And a pair of economists over at Wells Fargo saying today that domestic firms are stomaching the cost of these higher tariffs and starting to pass them on to consumers. So if we can accept the reality that these costs are ultimately going to be borne by American businesses and consumers, talk to me about your expectations for the drag that could potentially have on U.S. GDP.
Yeah, it could be a drag. It's hard to say, I think, currently who's paying for it and how much. I mean, I think there's a blend of things going on, and it depends on the type of product. It depends on the mix, and depends how much is going to be offset by margins and the like. It's a little hard to say. It looks currently as if 30 to 50% of it or so is being passed on. But again, it's a little hard. We're still quite, in the early days of this. So I'm not quite sure I know how it's going to play out. It does look like US companies are going to be paying for certainly some of it, and they're going to pass that on. And is that going to be a drag? I think it works out as something of a tax rise. But then there's other taxes through the fiscal package that look as if they're offsetting some of that. So it's a little hard to know how it shakes out, I think.
So we're in the midst of earnings season here in the U.S. Bloomberg Intelligence was saying today that if you look at the Mag 7 companies, they're expected to post a combined gain in second quarter profits of around 14%. But if you look at earnings for the remainder of the S&P, they're predicted to be essentially flat. How are you viewing the overall equity market right now?
I view the equity market. I think it's clear, as you say, what you're doing is splitting out the Mag 7 stocks. So they're in a class of their own. They're fairly expensive, but they are fabulous businesses. They really are. They're bringing in money from all over the world. They're largely dominant in their respective spaces, and clearly the AI trade, the hyperscaler nature of it, is what's driving that. Now, I think what you're going to see is that this last year or so, the AI boom has accrued to those companies, the people that are building it out and buying the chips and spending lots and lots of money to try and bring AI, into the real economy. And I think over the next couple of years, you're going to see the rest of the S&P start to become users of that AI technology and that productivity boost. And you're going to start to see in a lumpy fashion, I think, where it'll be different for different companies as they start to adopt it. But I think you're going to see some real use cases of companies that are making use of that AI and seeing strange, unpredictable earnings jumps as they're using it better and margins go up. And I think that's how I'm viewing it, that the last year or so, you've seen the hyperscalers and the Mag 7 do real well on the AI trade. And the next couple of years, you're going to see those gains be actually used in companies, and you'll start to see that benefit broaden out to other companies.
At the risk of using a cliche, to what extent is the market right now priced to perfection? And by extension, if we get the slightest disappointment from a name like Alphabet tomorrow, could that create huge negative consequence?
Yeah, I think so. I mean, it depends on the scale of it. I think one of the things that's wonderful about AI is it really does live in the future, though, which means you can continue to kind of believe in the story. So I think what you'd most likely see in that situation, I guess it could come in two ways. It could either be that the CapEx build out is incredibly expensive, and that shocks people, and that could cause a disappointment. Or you could see for individual companies, particularly like someone like Google, where they're on the receiving end of challenges because of AI. I think in the former case, where you saw that the build out was expensive, it'd be easier to look through it because you could see that although it's expensive, they're doing it for a reason, and that companies will get a benefit from this, that they're not wasting money. I think if you saw it the other way around for Google in particular, that they were really starting to lose ground because of the core search engine business, and that things like ChatGPT and some of the other AI businesses were really encroaching in Google in particular space. I think that would cause problems for Google, certainly.
So we have a Fed meeting at the end of the month. We know there's been a lot of controversy around the fact that the Fed has been unwilling, at least at this point, to cut interest rates again. Right now, the market's convinced that September is the next meeting where that 25 basis point cut is likely. How are you viewing Fed policy right now? And if you could put that kind of in the context of a lot of the tension that seems to exist between, let's say, the White House and the Fed.
Yeah, there's a lot of political pressure being put on Powell and the rest of the FOMC for lower rates. Powell is clearly bearing the brunt of it. Obviously, Trump did appoint him, which is slightly strange. I think there's a good case. I don't think Trump's completely wrong here that the Fed should cut rates. I don't think they're particularly slow in doing so, but I think at this point it's fairly clear, I think, that things are slowing somewhat, and that the inflationary dynamics that you saw a couple of years ago aren't really there. You can really see that in house prices, and some of the very interest rate sensitive sectors of the economy look as if they're slowing. So I'm not particularly worried about inflation picking up again. And I think that when you've got a Fed rate that is 4.33 or 4.3 currently, that is notably above where I think inflation ends up, particularly if we adjust for the housing issue. I think Trump is likely right. I mean, I don't think we need to be cutting rates by 200 basis points. That I think is a bit extreme there. But should the Fed be cutting in July and September? I mean, yes, I think so. I mean, you could get rates down 50 or 75 basis points, and I don't think that would be unreasonable at all. I don't think it's right that they're putting quite so much pressure on them. I don't think that's particularly helpful. And if you do end up with a Powell that was fired, I don't quite know how that would play out. I imagine you'd see a steeper curve because you'd price that rates would get cut more drastically, and then you might price that you'd lose some control of the back end of the curve. But it's a committee with staggered appointments. So I think there's plenty of other people on the Fed that will continue with the monetary policy in the manner in which they've been doing it so far.
David, we'll leave it there. Always a pleasure. Thank you so very much. David Aspell, partner, co-CIO at Mount Lucas Management, joining from just outside Philadelphia here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Markets are now looking ahead to megacap tech earnings from both Alphabet and Tesla. Companies are set to report in under 24 hours. Let's take a closer look now. I'm joined by Stephanie Leung. She is the Chief Investment Officer at StashAway. Stephanie joins us from our studios in Hong Kong. Thank you so much for making time to chat with me. I'm going to play to one of your strengths, technology, and particularly artificial intelligence. On Wednesday here in the States, after the bell, we're going to hear from Alphabet. And I think the market's going to be very curious, not only on spending when it comes to AI, but what some analysts have expressed concern over in the past, which is how AI may be impacting the company's core search business. How do you understand the risk of some of these AI-backed chatbots posing some sort of risk to a business, even for Baidu in China, which has around 70% of the search market? Is AI a way for this to be reimagined, do you think? And maybe does it represent a near-term risk?
Yeah, I think, you bring up a very, very good point, right? In the sense that, of course, if you think about the internet era, search was a very, very profitable business. And Google, Baidu pretty much have like a dominance or monopoly in these businesses. However, as we enter the AI era, if you think about kind of just what people go to search engines to do, they're basically asking questions. And you can ask these questions much more directly and get much better answers by going to the LLM chatbots to ask the same questions, and they will give you a much more comprehensive answer rather than just the 10 blue links that Google would provide. And I think that actually creates a sort of a dilemma for companies like Google in the sense that, they know that that's the direction that things are going. However, of course, they have existing sort of earnings to try to protect. So they need to, they are trying to actually strike a balance between like kind of not cannibalizing the existing business, but meanwhile making efforts to make sure that they don't get this kind of extinct in the new AI era. So for example, AI, if you go to Google search right now, you see that they will provide a AI generated search summary. And that's sort of some of the efforts to help the company to migrate. Of course, I think if you look at the share price and also valuation, that concern seems to me to be quite well understood by the market, in the sense that if you kind of compare Google's valuation versus others in the Mag 7, they are the lowest, and they are also trading at the lowest kind of price to earnings valuation compared to its own history. So I think if you just kind of look at Google's kind of whole business. Of course, search is a very, very important part. However, there are other businesses. For example, Waymo is making some very good progress in terms of autonomous driving. That's also AI driven. If you look at kind of YouTube, it's also doing well. There's also kind of AI enabled kind of algorithms that help them to sort of promote relevant videos and relevant content. So I do think that there are actually, of course, there are other levers that Google can pull, and one of which is, of course, like if you and I kind of look at what is the most popular mail protocol and mail program out there, it's still Gmail, right? So I think there are optionalities there. It's about just kind of in the interim period how to balance kind of the search business with that. So
if you're looking at opportunities in AI in China, are you more focused on the software side, or are you looking at the hardware story and maybe semiconductors? How do you play it?
I think if you look at the semiconductor or hardware side, it's very, very focused in a few kind of companies that have the technology. So by that, I mean, for example, NVIDIA. NVIDIA has the chips that are kind of ways ahead. And if you look at all the recent kind of announcements from big tech companies, like, for example, Meta's big announcement of their data centers, they are still predominantly using NVIDIA technology. If you look at kind of in China, of course, recently President Trump lifted the restriction to export H20 chips to China. And NVIDIA is receiving a lot of orders, and I mean they're citing supply shortages. So still, NVIDIA is the kind of the dominant player in the infrastructure layer. Of course, companies like Huawei are catching up, but I think they are still kind of somewhat behind. On the application side, I think that's where it gets more interesting, right? Because it's not that kind of dominated by one or two players. I think in the application side, you can see a lot of very creative uses of the underlying technology in terms of driving usage, driving revenue, or cutting costs. And here, I think you can see that in the US, there are different companies in different verticals, I guess, making like big strides. And also in China, right? If you look at kind of the software companies, I think they are one of the first to benefit from these AI coding agents, for example. And these actually benefit a lot more companies than just the infrastructure layer.
You touched on autonomous driving in China a moment ago, and I'm curious, how is that progressing? Are there developments that look promising at this point where you want to be invested in those companies?
I think in China is developing very, very quickly, but still, if you look at kind of where the technology is in the forefront, is still in the US, right? Tesla is leading the effort in developing some of the more advanced AI-driven kind of, I guess, autonomous driving technologies. As I mentioned, Waymo is also making some very, very good progresses. So these are companies that are at the forefront. I think in China is where the application of these technologies may actually surprise on the upside, in the sense that I think if you look at kind of how China can deploy these technologies, it tends to be a lot more efficient. So I think that's sort of it's at the application layer where some of these companies can benefit.
We know that trade negotiators from the European Union and the U.S. will be meeting again this week for more trade talks. So whether we're talking about the European Union or China, we do have this August deadline in front of us. But I'm curious, are you optimistic that we're going to be able to kind of turn the page on this tariff story soon?
So I think if you look at Trump's policy, it's been kind of kicking the can down the road. And if you listen to the latest Besant interview, what he mentioned was actually quite telling, right? He said it's about the quality of the outcome, not the timing of the outcome. So I think, again, the next kind of deadline that's coming up is 1st of August, which is kind of a few days from today. But I do suspect that they will try to kick the can down the road again, which I think it's sort of expected or digested by the market. And if you look at kind of the current level of like actual tariffs that are being imposed, they are sort of in the 10 to 20% range. And I think if you look at where it the level of tariff really hits U.S. economy, if it goes up to about 30%, I mean that's when things get much more challenging. So I mean we'll have to see what the outcome is. But I mean I think if you look at kind of the summer months, August, September tends to be like the worst months in terms of seasonality. I mean liquidity is quite thin, and I mean we've had a market that has rallied like 20-something, 30% from its bottom. So I wouldn't be surprised if in the summer we see some headlines coming out from these trade talks that could rattle markets and create 5 to 10% correction. However, the fundamentals are still quite solid. So I think those are kind of good opportunities for people to still, add to the risk.
Stephanie, we'll leave it there. It's always a pleasure. Thank you so very much. Stephanie Leung, she is the Chief Investment Officer at StashAway, joining from our Hong Kong studios here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.